And the IRS has extended that to mean if you even receive an allowance for expenses. Several years ago, Wayne and I were out in California. This was before the dot-com bust. And in the Silicon Valley, you couldn't find office space. They were everywhere. Everywhere. I had a client whose son was out there. He had started his own dot-com company, and he was living in a travel trailer and working out of the travel trailer. There was no place. And so many of the dot-coms were telling their employees, we don't want you to come in because we have no place to put you. We want you to telecommute, work at home. Now that would have been a required condition of employment, but they gave them an allowance to cover their utilities. And when they did that, it knocked it out. So having it, can an employee have it? Yes. Is there a probability the employee will have it? Very, very low because of the requirements. But not so much for an individual, self-employed. Now, we all know the whole purpose of the office in the home has nothing to do with the deduction that you're going to get. We want it for one reason: travel, transportation, the automobile. That's why we want it. Because if we have an office in our home and we get in our car and we go to see a client or we go out to work, it is not a commute. That's the whole thing. But nonetheless, just keep in mind that on the 8829, there are 3 levels of expenses, and we have to be able to document these. Now, I look at it again very simplistically. Level 1 expenses are those we would get whether we had an office in the home or not. We get it by pure home ownership. Mortgage interest, ad valorem taxes, casualty losses. The difference is if we can move them over to the 8829, we're going to get them above the line, as we call it. Our AGI will be reduced, and we're beginning to see more and more and more the importance of that AGI when it comes to other taxes. So those we will get, period. There's never a carryover. Schedule C, Schedule A, we get them. But the second and third category are different. The second category are all other expenses of maintaining the office in the home, except for those expenses that reduce basis. And the last are the ones that reduce basis. Now, why we get a carryover for these is very simple. We are not permitted to create a loss on the Schedule C through the use of an office in the home. And so these Category 2 and 3 expenses that we do not get to use are deferred. They're carried over. And we can use them in future years. Now, be careful with your carryover. It's not absolute. These are not the equivalent of suspended passive losses. They are deferred expenses. We can use them as long as we have one income that's self-employed and we still qualify for an office in the home. We can use them, secondly, where we have income from that entity. Third, we have not sold the home and we still have the same residence. And fourth, we haven't changed our business entity. That is, we were accountants, we're still accountants. We sell the home, we have deferred expenses, we lose them. After what you hear today, you're saying, good grief, I'm going to get out of the tax practice business. I'm going to get in something easy. I'm going to start selling health insurance. You have changed the nature of the industry. Your North American code classification system code has been changed. You lose them. But the thing is, we've got to document. Now, what they have given us is a revenue procedure 2013-13. Under this revenue procedure, in lieu of actual expense, the taxpayer may elect on a year-to-year basis the safe harbor rule. The election, once made for a year, cannot be terminated for that year. But it does not carry over to the following year. And therefore, we may go back and forth between actual cost and the safe harbor rule. No formal election is made. We enter amounts on line 30 of the Schedule C. And these will be brought from a worksheet that they have not yet designed. But I'll show you what's going to be on there, at least what we think is going to be on there. So we can make this election. Now, the safe harbor provides that we may deduct $5 per square foot per year for up to 300 square feet. If you have more than 300 square feet, you will be limited to $1,500. If you have fewer than 300 square feet, you'll be limited to the number of square feet times $5. And I bet we're going to see a significant number of 300 square footed offices from people that probably won't qualify for the office in the home, but they are going to put it on there. Now, let me show you the problems with it, and they're not problems, they're situations. Go to item E, please, at the bottom of 15.2. Now, keep in mind the way I worded the prescribed rate. It is $5 per square foot per year. It is never apportioned or factored. The $5 is the standard. It is the constant. Now, what are our special situations? Bottom of page 15.2. One, we don't use the office or have the office in the home for the entire year. Look at the example at the top of page 15.3. We have a client. They start a business, and they started in September. They started on September the 10th. And they have it for September the 10th to the end of the year. Now, we are lucky and fortunate in that when they wrote the rule, they said that if you use the space for more than half a month, for more than half the number of days in a month, it is a full month. Less than half the number of days in a month, you don't get anything for that month. So it's all or nothing. We have 4 months: September, October, November, December. The amount of space used, I believe, is 400 square feet. But we're limited to 3. So we have 4 months times 300 square feet. That's 1,200 square feet. Now we have to average it. And they make us divide it by 12. we have on average, for the year, we have used 100 square feet a month times the $5. Notice we don't apportion the $5. If that's $5 for a year, that's less than 50 cents a month. And we're not going to have to get into all of that mess of pennies and all that. So they apportion the square footage. Look at the second special situation, item number 2. 2 taxpayers are sharing a home. It could be a significant other, a spouse, a roommate, whatever. Can both of them take it? Yes, but not for the same square footage. So each one can get up to 300 square feet, but it's got to be different square footage. Look at the special situation number 3. More than one home. You move. Or what I dream of doing is on April the 30th, packing whatever extended returns we have, locking the office up, and going to my place on the lake and staying the rest of the year. I am. You have to dream. I dreamed about it. The chairs up on that level upstairs, they are so comfortable. I shouldn't tell you because I want one of them at lunch, but I may fall asleep. And I sat up there and I thought how beautiful it would be to look out on the lake, but then how sickening it would be to have to turn away from that to do a tax return. But anyway, what happens? If you have more than one home, you can only use it for one. Only use it for one. The other one, you can use the actual, but you can't use it for 2 homes. The fourth special situation, you have more than one business. You are a tax practitioner and you have an office in your home. But you also, on the side, sell software used in the elementary schools to teach reading, trying to get something that's not business oriented. You know, it's not a trade or business thing like that, but it's sales, which is a trade or business. You have both offices in your home. Your accounting tax practice constitutes 400 square feet. And then your other one, which is very small, is only 200 square feet. You have 600 square feet of office space. You're allowed 3. So we apportion it. For the tax practice, 400 over 600 times 300 would be 200 square feet times $5. There's your $1,000 against your tax practice. And of course, the remaining 2, 6, 1/3 times 3, 100 times $5. There's your $500 for your sales, your software sales. So those are the issues. Now down at item F, what are the limitations? As we've already seen, I'll just add this one to it. Never can we exceed a maximum of 300 square feet. Cannot be done. That's one limitation. Secondly, as with the regular method, we cannot create a loss. We can only offset the Schedule C income, but once it becomes 0, it stops. And unlike the actual method, we are not permitted to carry any of the safe harbor amount over to the next year. That is not permitted. Third, what about our expenses that had been deferred when we were using the actual method? They do not expire. They continue to be deferred. We can never use them in any year that we elect the safe harbor. But they carry over to the year after that and the year after that and so on until we go back to the actual expense. Fourth, go to item L2, page 15.5. If we elect the safe harbor, and this one really surprised me, it is deemed that the depreciation for the year you elect the safe harbor is 0. Now, the reason that surprised me, think about your mileage, your standard mileage. In that 56 cents a mile, there is an element that is depreciation. Often ignored, no doubt, but it's still there. There is no such comparable concept here. It is deemed to be 0. Now, let me tell you what happens. Let's assume for 6 years you deducted the actual expense. But in 2013, year 7 of having an office in the home, you use the safe harbor method. You didn't have a lot of expenses. They kept no records, whatever. So you use the safe harbor. That's year 7. Next year in 2014, year 8, you go back to the actual. And when we come down to calculate the depreciation, we get our depreciation table out. We go to the month where it was first placed in service. We count down, and we've already used the first 6 factors. But the 7th year, we use the safe harbor. We can never use the factor for year 7. This is the 8th year that we have used, had the office in the home. We must use the factor for year 8. Now, we have no depreciation at all for year 7, but we lose it. We go to year 8. Now, by doing that, think of something. No matter which method you use, after 39 years of that office in the home, there is no depreciation available. See, we're not permitted to extend the period beyond 39 years because we elected the safe harbor method. And that is the quirk on this. I beg your pardon? You still have your basis. If you've always used the safe harbor method and you sell your residence, there is no depreciation. There is none. Because it's deemed to be 0. But what they do force us to do is when we go back to the actual method, we skip the factor in the table for the year or years we used the safe harbor rule. Now, if you'll turn into chapter 16, I want us to go to the one thing in particular. When we started putting more emphasis on the 3.8 and what we're going to do after lunch, we had to kind of pick and choose out of the chapters. But I want you to go to page 18. It's a case study. Page 16, 18. Last year, for the first time ever, I had a client with debt discharge income. I'd never had that before. It happened to be on a Visa card, $7,000. Now, under the Revenue Act of 1913, the preamble to that act said this: all income from whatever source derived is subject to the provisions of this act. And we're still arguing over what constitutes income after 100 years. Well, obviously, Congress put into place Code Section 61. Code Section 61 says that if one settles a debt at less than the amount owed, that discount, that difference is debt discharge income, and it is taxable. Goes on line 21, and it's always ordinary. Always. We tell you in the front of the chapter that this conflicted with provisions in Title 11 of the U.S. Code. Remember, the Internal Revenue Code is embodied in Title 26. But Title 11 deals with bankruptcies. And originally in Title 11, if you were in bankruptcy, the bankruptcy judge has the authority to cancel all of the debt. And it's amazing the power that they have. And they can take $1 million debt and say this debt is canceled. Now, Code Section 61 conflicted with that because it said, well, it may be canceled, but you're going to have $1 million worth of income. So Section 61 was amended by Code Section 108. And 108 says that if you are in bankruptcy and you have debt discharge income, 100% of that debt discharge income is excluded from the tax base. Period. No questions asked. Likewise, 108A addressed what happens if one is insolvent. One is insolvent when the amount of their debt exceeds the fair market value of the included assets. And to the extent of the insolvency, we can exclude. Now, the point is that we don't have a benevolent government. You may be surprised. But if we exclude debt discharge income, we have to pay the price. And the price we pay is a loss of tax attributes. Just mark this 1618 and flip back right quick and go to the very bottom of page 16.1. If we're able to exclude, even if we're in bankruptcy and we exclude, then we're going to lose tax attributes, something of value, something that will reduce our taxable income or our tax liability in the future. And you can see the first thing we lose are our net operating losses. Then look at the top of the next page. General business credits, minimum tax credits, capital losses. The basis in depreciable and non-depreciable assets, but not below the debt immediately after the discharge. We can't put them underwater, as the new term is. Then we have our passive activity losses and credits and our foreign tax credits. Now, credit is different from a passive loss. A loss reduces taxable income dollar for dollar. The credit reduces the tax. And therefore, if we are required to reduce a credit, we reduce a credit by $1 for every $3 of excluded debt discharge income. That's by statute. Now, if you'll turn over to page 16:7. Mechanically, the way this is done, where we have debt discharge income, we exclude all or part of it. Now we're going to reduce tax attributes. But the irony is, at this point, they turn in favor of the taxpayer, and the tax attributes are not reduced in the year of the exclusion of the income. If you have debt discharge income in 2013 and you're able to exclude it, and you have an NOL, you use the NOL, you have passive losses, you use them, you have credits, you use them, you have rental property with depreciation, you depreciate it. You just do the return like you've always done it. And after you complete the return, you make a schedule of what's left in capital losses, bases in property, net operating losses, all of that, and you complete the 982. The 982 is attached to the 2013 return, and these reductions take place on day one of the next tax year. Now let me show you a couple of things here. Look on page 16:7, line 10B. 16:7, line 10B as in boy. That is the reduction of bases in your principal residence. You recall I told you that is still in for 2013? Now, in order to reduce bases, you must own that residence on the last day of the year. So if there has been a foreclosure, there's no basis to reduce. You have to own it. Look back up at line number 5. It says that you elect under section 108B5 to apply first to reduce the basis under section 1017 of depreciable property. When you saw the regular ordering rules, the first thing we lost was the NOL. But now you can make an election to first reduce the basis of depreciable property. You study that election. It's dangerous. Why? Because there is no floor. We saw if you leave it in the right order, you reduce the basis of depreciable and non-depreciable property, but not below the amount of the liabilities immediately after the discharge. That doesn't apply here. It can go to 0. Now let me tell you the danger of it. When you reduce the basis in property, it's deemed to be depreciation. You've depreciated the property. So you're going to lose a deduction for depreciation over the remaining life of that property. But that's not the bad news. The bad news is, no matter what the character of the property, even if it's real estate, it is deemed to be section 1245 depreciation. And I hate to say that anything in the code makes sense, but this does. You sell the property, you've reduced the basis because you excluded what would have been ordinary income. Now you sell the property and you have a gain. And to the extent of that basis reduction, you have ordinary income. Can you see they're not doing you a real favor? It's just a deferral if you have assets. Yeah, the only way to get around it is to die. And they'll think of something to stop that. Now, one last thing. Now go back to 18 and 19. Because here is to me, it is the most significant point in the chapter, and it's not all in here, and that's what I want to share with you. I'm a great believer in tax planning. Sometimes it works out, sometimes it doesn't. But we need to be able to give our client every option. Because if we don't, they're going to come in and say, well, I was talking to Joe, and Joe's accountant said that you could do so-and-so. Well, you find out that Joe's accountant's the UPS delivery person. That's where they're getting all this tax advice. And I don't make fun of them because those guys, they're good friends of ours. When they come to the office, we always have coffee in the winter for them and a cold drink in the summer. And if somebody works, it's them. And boy, I feel for them between now. Paper said today the 23rd was going to be their biggest day. They'll run probably 24 hours that day. But anyway, look at this, and I want to show you something. Here we have a foreclosure coupled with cancellation of debt. The only way that can happen is that this property must be financed with recourse debt. The key element in the 1099A is box 5. It says, if checked, the taxpayer is personally liable for the debt. Therefore, if it's financed with recourse property, there's a possibility of two transactions. First, a gain or loss on the deemed sale, and secondly, a discharge of debt income, of the debt. Now, our problem is if it's a deemed sale, what is the selling price? Now, let's look at the little worksheet on page 19. Non-recourse, in this case, picking up from the 1099A, the fair market value of the property was $350,000. The amount of the debt was $400,000. The basis was $5,000. Well, if it's without recourse, what does the creditor stand to receive? Only the property. They are giving up their note for the property. And therefore, the balance on that note is the deemed selling price. So where it's non-recourse, line 1 is fair market value. Balance of the loan is $400,000. Line 3 is the key. If it's non-recourse, the deemed selling price is the amount of the note. The basis here was given as $500,000. There's a $100,000 loss. And it may or may not be deductible, depending on the character of the property. Look at the second line, recourse, second column. Value is still $350,000. The note was $400,000. But because it's with recourse, the deemed selling price is the lesser of the fair market value of the property, or $400,000. Therefore, they take back the property, they get $350,000. The debtor still owes them the balance. So here we have a $150,000 loss because the deemed selling price is $350,000. Now down in the bottom, if you'll just put this under the recourse column, put debt $400,000, fair market value FMW $350,000. The difference of $50,000 is DDI, debt discharge income. Now, if you will look at these, you'll see that in the recourse column, we have $150,000 loss. We have $50,000 of debt discharge income that offsets to a net loss of $100,000, the very same net loss that you have for non-recourse. Now, here's the final question. If this is recourse debt, and there was a foreclosure, and this was a passive activity, would it enable us to take a deduction for all the suspended losses? Yes. Absolutely yes. The fact it was repossessed doesn't have any effect on it. It was deemed sold. And if it was the only activity there, the answer would be yes. Now let me give you the good news. It is in Rev Ruling 9292 that they left off the bottom of this page. Rev Ruling 9292. I cannot tell you the significance of this, that you might have the opportunity to help your client. Rev Ruling 9292 says that if we have debt discharge income in a passive activity, the debt discharge income is passive. Now think about that. Because when we sell a passive activity, we take and we add together the suspended loss, the income or loss for the current year, the gain or loss on the sale. That's what we do under normal conditions. And when we add all of these together and they add up to a net gain, that is, all of it is a gain, the gains offset the losses, every item on it is passive. We put the income or loss for the current year and the gain on the sale on the 8582. It not only gives us all of the losses for this activity, but we have gain left over that can be used to offset other suspended passive losses. Now that's your planning. But it's even better if you find yourself in the misfortune of a foreclosure. Because now, under Rev Ruling 9292, we take our suspended losses, we add the income or loss from operations for the year, the gain or loss on the deemed sale, and the debt discharge income that is not excluded under 108A. And if we add all of those together, and they net out to be an overall gain, we even put the taxable debt discharge income on the 8582. That gives us more passive income and the ability, if we have suspended passive losses, to absorb more of them. All in knowing that one thing. Now keep in mind that if we add those things together and they come out a net loss, that's okay too. We might not get other suspended losses, but we take Pink Pearl, go to the 8582, and we remove the suspended loss. And we carry all of those losses to the appropriate form, and that's where in the instructions you will read where it says you mark it sale of PAL, passive activity loss. So please don't forget Rev Ruling 9292. And you know what else you don't need to forget? That it's lunchtime. Now, Ruth, did you want to say something right quick?
Thank you. There's one more vendor that would like to speak to you for a quick minute, but before we do that, I wanted to let you